The QuickBooks workflow is driven by the forms you use. Forms are individual windows that open when you're completing a task, such as filling out a check, creating an invoice, or entering a bill. Each of these forms has a specific accounting purpose. Forms are hardwired to always debit or credit a specific account. To use QuickBooks successfully, it's essential to know the effect each form has on your financial statements. The purpose of this tutorial is to go over the two major workflows on the desktop: the sales cycle, inflows of cash, and the purchases cycle, outflows of cash, and explain exactly what QuickBooks is doing when you use them. First, we'll cover inflows of funds into the business. This includes both cash sales and credit sales to customers. QuickBooks uses the following forms to record how a business receives funds. We'll go over how each one of them affects your accounts. First is purchase orders, sales orders, and estimates. Depending on the configuration of your file and the version of QuickBooks you're using, you may or may not have these icons on your desktop. The important thing to remember about these windows is that they are non-posting when you first record them. Transactions entered using these icons do not affect your financial statements until they're converted into either a bill, an invoice, or a sales receipt. Create Invoices has a specific accounting function to increase accounts receivable. Invoices are mapped directly to the accounts receivable account, and each time you create an invoice, you increase the accounts receivable account balance. So rather than think of this icon as just an invoice, think of it as creating a debt someone owes you. Behind the scenes, QuickBooks will always increase accounts receivable. Since accounts receivable is an asset account, an increase is created with a debit, so there must be corresponding credits in the same amount. These credits usually increase a revenue account, but not always. Sometimes they're used to increase a liability account or reduce an asset or expense account instead. At the bottom of the invoice, you'll see the amount that will be debited to the accounts receivable account. The offsetting credits are determined by the items that are listed on the invoice. Each of the listed items will direct a credit to the account that's mapped to that item. Another way to create an account receivable is with a statement charge. Statement charges are much more limited than invoices, since you can only use one sales item on each statement. Each time you enter a statement charge, the accounts receivable account is increased. In accounting terms, accounts receivable is debited. The corresponding credit is selected through the item that you use, and that item determines where the credit is directed. Like an invoice, statement charges always increase accounts receivable. Receive payments is the other half of the invoicing function. It's designed specifically to be used in conjunction with the invoice function. When someone with an outstanding debt remits payment, it is used to lower that customer's account balance. So rather than think of this as simply receiving a payment, think of it as reducing a debt someone already owes you. The invoice and statement charges and receive payment function together represent your extension of credit to customers. Behind the scenes, whenever you enter a payment here, QuickBooks always reduces the accounts receivable balance for the customer. In accounting terms, it credits accounts receivable, and the corresponding debit is usually sent to the undeposited funds account. The amount of payment applied at the bottom of this window is the amount of both the debit and the credit. If you don't want to use the undeposited funds account, the preference is found at Edit, Preferences, Payments. If you choose to deselect the undeposited funds option, you're able to use a drop-down menu in this window to select where you want to direct the funds, but that's not recommended. QuickBooks functions best when you follow the workflow. This window also serves a second function. It applies payments to individual invoices using the table in the middle of the window. When you use this window, you have the ability to enter a payment without selecting an invoice for a debt owed to you. But at some point, that payment will need to either be applied to a customer's outstanding debt or be refunded. The undeposited funds account. There's no icon for this function or related window to open, but be very aware that it exists. The purpose of undeposited funds is to simplify reconciling bank statements. Since banks usually will show only deposits as a single line item, it makes it easier to match up depositing multiple payments with the related item on the bank statement. In other words, it's a holding account. The balance in this account should always match the funds you're physically holding prior to a bank deposit. Without clearing out this account, it makes bank reconciliations nearly impossible. Sales receipts. This window is usually used for cash sales, where no customer debt is involved. Its icon is outside the receivable workflow because the accounts receivable account is not involved in the transaction. Rather than think about this as a receipt, think of it as immediate payment with no customer credit involved. The form looks similar to the invoice, but the total amount, instead of increasing accounts receivable, always directs increases to the undeposited funds account. In accounting terms, it debits undeposited funds. The corresponding credits are related to the items used in the body of the form. These credits usually increase a revenue account, but like the invoice, are sometimes used to affect other accounts instead. Sales receipts are useful if you have a cash-based business and record a day's sales like cash register total on a consolidated daily basis. Sales receipts also serve a purpose for customized transactions like customer deposits. We'll get more into those in later lessons. The Refunds and Credits icon creates a credit memo. The credit memo is the mirror image of an invoice. It looks almost exactly the same, but behind the scenes it does the exact opposite of what an invoice does. It's the reverse of an invoice. The credit memo will always decrease the accounts receivable account. In accounting terms, it will credit the accounts receivable account. The related debits are determined by the items you include on the credit memo. The credit memo is extremely useful if you charge sales tax because it allows you to reverse any sales tax charges on customer discounts so you don't overpay your sales tax liability. When you use taxable items on the credit memo form, QuickBooks will calculate the amount of sales tax to reverse the same way it calculated the sales tax when you initially created the invoice. Credit memos are also used to create cash refunds for customers. If you select the Use Credit To button at the top of the window, you can opt to create a payment to the customer from the screen. Record deposits. This is the window where you document the funds you've taken to the bank. In accounting terms, it debits your bank account, increasing the balance of that asset account, and credits the account you select. This window will always increase the bank account you list at the top of the screen and route the corresponding credit to the account you select in the drop-down menu. The From account is where the credit will be directed. If you're entering funds from undeposited funds, that account will automatically be listed on the deposit form. If not, you manually select where to direct the credit. The Record Deposit screen is a powerful function in QuickBooks. Since it always debits the bank account and allows you to directly select what account to credit, in many cases it can be used like a journal entry but leaves a better electronic paper trail. In lieu of the Record Deposit screen, the bank register can be used to directly make entries. Using the register, the bank account will be either increased, a debit using the deposit column, or decreased, a credit using the withdrawal column. The account you list on the entry into the register will be the offsetting debit or credit. Be advised that the register should not be used if an invoice has already been created. If it is used for the receipt of a payment and an income account is used for the credit, income has been counted twice since it was already posted when the invoice was originally created. If accounts receivable is used in the register, your account balances will be correct, but QuickBooks won't know that the payment was received on a particular invoice and will continue to show it as outstanding on an aging report. You'll still have to go into Receive Payments and associate the payment with the invoice. For best practices, follow the order of the functions on the workflow diagram on the home page. To summarize, invoices will always increase accounts receivable, a debit. The offsetting credits are determined by the items. Statement charges will always increase accounts receivable, a debit. The offsetting entry is determined by the item you select. Receive payments will always decrease accounts receivable, a credit. Under normal circumstances, it will increase undeposited funds. If the preference for undeposited funds is turned off, then you manually select where the debit will be directed. Undeposited funds is a holding account, and its purpose is to simplify bank reconciliations. Sales receipts always increase undeposited funds, and the corresponding credits are determined by the items. Credit memos always decrease accounts receivable, a credit. The items used on a credit memo determine the corresponding debits. Record deposits will always increase the bank account, a debit. The From account selected will determine where the offsetting credit is directed. To keep track of outflows from the business, we use the Accounts Payable workflow or write checks using these QuickBooks windows. We'll go over each one of them individually. Our first icon in the Accounts Payable workflow is Enter Bills. Enter Bills will always increase the Accounts Payable account. In accounting terms, it credits the Accounts Payable liability account and debits the account you select. A better way to think of Enter Bills is increasing the bills to pay later. The total on the check form will always be the amount that accounts payable is increased by. It's important to remember that when entered, this amount will be recorded as a liability on the balance sheet. The bank account is not yet affected. Positive numbers entered in the table below will always be recorded as debits. Remember that debits increase expenses. The table on the bottom also has an Items tab. This is for when you're keeping track of expenses related to items. For example, it keeps track of inventory purchases. It also helps keep track of expenses related to individual customers and jobs. And it's used to keep track of both payroll liabilities and sales tax liabilities. The Pay Bills window has a very specific purpose. It will always decrease the accounts payable balance and the bank account balance. In accounting terms, it debits accounts payable and credits the bank account. If you need to change an amount, select the bill and then click the Go To Bill button at the bottom left of the window and edit it here. The bank account selected is listed in a drop-down menu on the lower right of the window. You can also use this window to apply credits from vendors to new bills. I'll show you where to enter vendor credits in just a moment. The Write Checks window looks almost exactly like the Enter Bills window, but instead of increasing the balance of the accounts payable account, it will always decrease the selected bank account balance and directly affect the accounts you select in the table on the bottom. In accounting terms, the Write Checks form will always credit the bank and debit the accounts or accounts mapped to items listed in the table on the bottom of the form. There is some confusion among QuickBooks users about whether to use Enter Bills or Write Checks. Ultimately, they serve the same purpose, to record your business's cash outflows. But by using the Accounts Payable workflow, Enter Bills and Pay Bills, there are some advantages. By entering a bill, QuickBooks will create an error message if a bill number from a vendor has been entered twice, preventing a bill from being paid a second time. Using Enter Bills also provides you with an accurate accounts payable aging report, helping you manage your outstanding short-term debt and cash outflows. And if you use inventory, Pay Bills helps to match up purchase orders to bills. So using Enter Bills and Pay Bills is slightly more work, but it's a more accurate way to record your expenses. The important thing to remember is that you should never use Enter Bills and Write Checks for bills on the same account. If the bill amount differs from month to month, it becomes very difficult to reconcile that account if it contains both outstanding bills and written checks, since the checks aren't automatically matched to a bill. A good rule of thumb is to use your accounts payable for all physical bills that come in the mail, or at the very least, all regular recurring expenses. If you receive a credit from one of your vendors to apply to a future bill or for an expected refund, you can use the Enter Bills window to record it. At the top of the window, you have the option of recording the vendor's credit balance. If this option is selected, the Enter Bills window will act similar to the Credit Memo window. Enter Bills now has the exact opposite effect. The vendor's account is decreased, and the expenses or items used on the table in the lower portion of the window are also decreased. In accounting terms, accounts payable is always debited, and the expense selected on the lower portion of the window is credited. To recap, Enter Bills always increases accounts payable. Since payables are a liability account, it's increased with a credit. The offsetting debit is selected either by the accounts you select or the items that you select that are mapped to accounts. Pay Bills will always decrease the accounts payable account and decrease the bank account. Write checks will always decrease the bank account. You select where the offsetting debits go with accounts or items. Vendor credits will always decrease accounts payable. You select where the offsetting credits go. When you understand the workflow behind the windows in QuickBooks, you'll have greater control over what QuickBooks is doing behind the scenes, especially when you're tackling more challenging transactions. Try to look past the icons on the desktop and the forms that you fill out in QuickBooks, and recognize that each form has a special accounting purpose. The stronger your understanding of how each QuickBooks form is hardwired into a particular action behind the scenes, the easier entering transactions in QuickBooks will be.